Loving the Smart Property Investment Show? Then you're going to love tuning in every Monday to the Scouting Australia podcast, hosted by Sam Gordon, Smart Property Investment Show's most downloaded guest.
That always just triggers in my mind. Like I'm always wanting to look after people because of what happened to me there.
What are you waiting for? Listen to the pros at the Scouting Australia podcast, now on all your streaming platforms, and get educated.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Good day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Recording this middle of April. It's always good to be on air, working our way through property. A lot of questions coming into Smart Property Investment at the moment. Everyone with queries around, is it the right time to invest in property? Well, you speak to most experts, they'll tell you any time's the right time to invest in property if you're prepared, if you've got your debt levels in check, if you've got a pre-approval, if you've got 1,000 other things in line, it's probably a good time to invest in property. And a lot of the scuttlebutt around at the moment is the bottom of markets that CoreLogic has come out saying Sydney, for example, has bottomed. Well, that's what the data is telling it. Whether or not it's going to be up and down again, who knows? But a big part of portfolio construction, so that sounds like a complicated term, but it's pretty much the assets that sit inside of whatever vehicle they sit inside within to create wealth, mixing it up, making sure you've got the right assets that you're trading and transacting in them, particularly with property strategically is really important. Something we focus a lot on smartpropertyinvestment.com.au, but I like to bring people in to have a yarn about this because one person's portfolio is very different to another person's portfolio. They have their own fingerprint on it, their own DNA. There's a million analogies you can use around it. Damien Collins is the chairman of Westbridge Funds Management. You may also know him from Momentum Wealth. He's been around this game for some time. Damien, dialing in from Perth. How you going?
I'm good, Phil. You make me sound old, but yes, I have been around for a while.
Yeah, but we both have. But I guess how many different market cycles have you seen? This will give you a sense for how long you've been at it and how you view the world.
Well, I was too young in the late 80s, early 90s, but I remember my parents went through that one with the recession we had to have and the 18% interest rates. And that certainly, even though I didn't have a mortgage at that time, certainly have remembered that well. It's got to be at least 4 since then. We've had some ups and downs, and we will continue to have because property is one of those beasts that the supply to meet demand. It's not like it's a factory you can turn on the widget machine and spit them out quickly. It takes years to bring the supply to the market, and often the market gets oversupplied and it goes around and round. So anyone investing in property, you got to be willing to withstand the cycles because guarantee they're coming, and they will come every 7 to 10 years for sure.
Yeah, and different property areas in Australia operate at different cycles. Perth, for example, where you are, Damien, has been pretty flat for a decade and it's really just finding its own groove now. There's other areas like Sydney that go through cycles quite rapidly with speed, depending on what's happening, intrinsically connected with the economy and economic health, all that sort of stuff, bit outside the scope of today's podcast. But Damien, the RBA, Reserve Bank of Australia, left interest rates on hold in April. Was at the end of it? Put you on the spot.
Well, no one can be certain, Phil, not even Dr. Lowe can be certain. But I think it was a good time to pause to have so many consecutive interest rate rises. It's the fastest rate rise that we've seen in at least since the early late 80s, early 90s when we had a big run up there. So I think it was a wise decision to see how things sit. And only now, there's always a delay between the rate rise and people seeing their mortgages. And then they say, oh, my rates have gone up a bit. And then it takes them a bit longer again to adjust their spending habits because they whittle down a bit of savings. So I think sit for a couple of months, see what figures come out. Are we at the end of it? I don't know. I hear mixed things. I heard something from the one of the major banks at a luncheon I was at, and they're saying that account balances and business bank balances are still pretty strong. So they're not seeing – normally they would see outflow of savings if the economy was starting to soften. So really hard to know whether or not we're going to see more rate rises. But right now, I think it's at the right balance for where it is. Hopefully we will pause for a bit, and I hope it's over. But if it's not, it might mean some a bit more pain in the property market. You mentioned there that are we at the bottom? That's another good question. I think some markets we are for sure. Other markets perhaps not. Depends what happens with the future rate rises.
Yeah, so it just goes to show how complex and complicated the environment is. And it's always like that. It's never easy. It just sometimes gets manifested by even more factors which can shape and change and give us, at least guys like me, a job to be able to talk on a podcast around all these different things happening. Are you noticing hitting people's back pocket yet, Damien, with your clients? Are people curbing their spending? Are they slowing down investing?
Not so much in Western Australia. What we've really noticed is in the residential side of the investment market, it certainly has impacted people's borrowing capacity. There's no doubt about that. The servicing rates are well into the sevens. They were in the fives not all that long ago. So it's impacting people's ability to borrow. But certainly Perth has coming off a very affordable market, medium price. Mid 500s, miles below Sydney and Melbourne, and pretty strong income, second highest income in the country. So as of now, we're really not seeing a lot of impact. I talk to people in business and I say, how are you going? And they're saying, well, really haven't seen any impact at all. I assume that will come. We've got what they call the rate cliff coming. I think it's a bit exaggerated, but there are some people rolling off fixed rates this year that have had a good time, and obviously the interest rate rises coming through, hitting their mortgages. So it'll have some impact, but overall, I don't think it's going to have too much in Perth. We certainly have noticed a lot of East Coast investors coming into Perth in quite a reasonable number, but they're very much targeting that low price end. So even they're a bit crimped on how much they can borrow. So they're really targeting that sort of 350 to 500 mark, which you can still get reasonable quality properties in Perth for. So we certainly, and they're very much focused on yield. That's been the big thing we're hearing from Sydney and Melbourne investors particularly. They want to get that 5% yield, which they can get over this side of the world. So I think there's still more to flow through, even if they stop rates now. But overall, certainly the Perth market hasn't been touched too much, and at least so far.
So the opportunity for first-time investors is to build a portfolio out with the future in mind. For those people who have been investing for some time, how do you go about potentially shuffling the decks to capitalize on equity growth that most investors have had if they've been in the game for 3-4 years? A lot of investors, if they haven't refinanced or extracted it, probably sitting in a lot of equity. But the whole idea is, okay, well, what's a model portfolio like? What's the ideal portfolio look like? And depending who you chat to, Damien, they'll tell you different things. But I guess the portfolio you create today probably won't be the portfolio you have in 10 years' time. How do you sort of have a healthy relationship with your portfolio and your priorities for it over many, many years if you're going to be successful as a property investor?
Well, I think the first thing, Phil, is you've really got to analyse who you are and your risk tolerance. And I've seen so many people over the journey who say, they want high growth and something they can bulldoze and develop into 2 or 3 or 4 units or whatever that might be at some stage in 10, 15 years. But then you get to the nitty gritty of it, that sort of property is probably going to be a lot older style. It's going to have a lot more repairs and maintenance, maybe won't attract the best tenants because it's not a good quality property. And then all those challenges start, the challenging tenants, the hot water system breaks, all the repairs and maintenance, and the cash flow bleed starts to burn, and people forget about their long-term goals and throw in the towel. So I think you've really got to sit down and it's what we do in the Momentum Wealth side of the business is sit down and do an investor profile. Okay, so what is your circumstances now? How much risk are you willing to take? What do you want to achieve? And that sets the framework. So for some people, they really can't go out of blue chip properties because they just don't have that risk tolerance and cash flow ability to wear some of the ups and downs you get with something that you can bulldoze and in 5 or 10 years. So setting your investor profile is the starting point. Setting your investor time frame is the next thing. How long do you have to achieve these goals? What do you want to achieve? And then ultimately, what's the outcome? Do you want to live off this portfolio, or are you trying to grow it to a substantial level and then sell it all and put it into something else? Or is it a combination thereof? Are you potentially going to grow a portfolio, sell some down in retirement and pay off some of the debt and live off that income? And then, of course, how much income do you want? That's the other thing. The residential is certainly historically been good for growth, but it also, particularly in the some of the major capital cities, the yields are pretty average. In Sydney, Melbourne, the yields are in the mid threes. That's gross, and then you take off your expenses, you might be netting 2. And that's where in our model, commercial property starts to come into play, where people should be considering a sector of the market. It's as close to $1 trillion. It's certainly not as big as residential, but in terms of of investment opportunity. There is a big market out there. A lot of investors don't even think about. But even now, with interest rates gone up a bit, yields softening, you can buy commercial properties either directly or through funds, where you can potentially get 6 to 7% net return. So it's a lot more than your net 2% you get on residential, and that's what. If in a perfect world, my philosophy on this is residential's a great place to start investing property because you can borrow a lot. You can borrow 80% or more. You can't do that in commercial. So it's a great place to start, particularly when you're in that income and earning phase and accumulation phase. So if you do have some negative cash flow, the tax department, ATO, helps because you get some of that back on, not all of it, you get some of that back in your income tax. So it's a great place to start. But if you're sitting on a residential portfolio and you want to earn $100,000 a year, well, certainly in Sydney and Melbourne, if you had no debt on those properties, you might need $5 million of net property. That's a lot of property to hold just to get $100,000 a year of income, and you might want more than that. If you had it all in commercial, you might get $300,000 to $350,000, but that does carry its own risks, which no doubt we'll talk about. To us, the happy blend is, again, everyone's going to be slightly different, but the happy blend is about 50-50. You got 50% in residential, which is still generally lower risk. You're always likely to have a tenant, but the returns are going to be a bit lower. 50% in commercial. So the blended yield, depending on which capital city you're investing, might be somewhere in the vicinity of 4 to 5% net. And so that means if you want $100,000 a year, you might only need $2 to $2.5 million of net investable assets in property to give you that income. So I think that's something. Again, there's that property commercial comes with its own risks, which I'm sure we can talk about. But I think investors need to think a bit wider than just building this big portfolio of residential properties. Yes, that's critical, great place to start, but I don't think it's where your investment journey should end. I think there's other parts to your property portfolio people should be considering.
Yeah, I completely agree. And most property investors I know at a point in time go, maybe I ought to sort of steer away from resi, and they look at other asset classes, commercial being one of them, whether it's sort of direct commercial or it's commercial inside of the super or it's via a fund. But you make the point of, building these big residential portfolios, and blue chip property means different things in different areas. It's price point, it's its age, it's all those type of fundamentals. But you find, and I know I've got them in my portfolio, these assets which you could bulldoze and renovate at a point in time, they become a massive headache. And nearly every investor I know goes through a cycle of just going, it's all too hard. It feels like, when something breaks, they all break. You've got to across your whole portfolio. It's a headache. And that's exacerbated when the cost of hold-em is going up by way of increased mortgages. So be careful about this idea and this dream of owning a whole bunch of residential property, because, it can be a lot of work. What's worked well for you, Damien, in your own sort of personal investing? Have you sort of, you made the switch at some point and started going into commercial?
Well, now that I'm sadly got a 5 in front of my birth date, Phil, yes, I have. So I started in residential like most investors, and you could gear heavily into it. You could borrow 80% or even more. And that was always a great place to start. And that's where I started building my property portfolio. But I did add some direct commercial when I got into my late 30s and 40s for some blending opportunities because the returns were better, and bought some. So I've got some commercial property in Perth and East Perth as well. But then once I got exposed to the funds business, and I bought into which is now Westbridge Funds, bought the majority part of that about 8 years ago. That really made more sense to me, investing in funds via a fund, and because I don't have to manage it, the team manages it. You also get the benefits, particularly in some funds, of diversification of assets. You got not all your eggs in one basket. I've had some great times with my direct commercial holdings, but I've also had times when they sat vacant for 2 years. So that can also be a challenge. And if that was my only property, that would have been very painful. Luckily for me, it wasn't. It was only a small portion of my total portfolio. But the good thing is, if you've got your commercial property, I guess, if residential, I think most of your listeners will have a pretty good idea about the pros and cons of residential and the risks and rewards. But commercial does give you a better yield, but it does carry higher risk, particularly around occupancy. That's the big one. We all know in residential, and we're in a great rental market at the moment, so anything you can rent at the moment, and rents are going up rapidly pretty much everywhere around the country because we've got such a shortage of supply of housing. But the commercial market certainly tends to swing in bigger ways, and we think a residential market is balanced at 3% vacancy and maybe at 5% vacancy, it's horrible. It takes us 6-8 weeks to get a tenant rather than 2 weeks. Well, when commercial property goes a bit softer, vacancy rates can blow out to 15-20%, and it means that things can sit vacant not for 6 weeks, they can sit vacant for 6 months, or in the worst case scenario, if you've got an obsolete asset, it can sit vacant for years. So that's why you need to really do your homework if you're going to go in that space, or put it in the hands of somebody who knows what they're doing. And it certainly does carry that additional risk of occupancy. And I think that's just something important for listeners to the podcast to know, that you don't just get a higher return for fun, you do get a higher return for risk. But there's ways to minimize, you can't eliminate risk, of course, but if you've got your assets in one commercial property, and I've seen people out there go and buy one commercial property for 3, 4, 5 million, or sometimes even a strata office for 500,000 to $1 million. That is a lot of eggs in one basket. And I've learned that myself is with my direct commercial holdings, that again, it was part of a broad portfolio, so it was okay. But if that was your only asset or one of your only few assets, that does carry a lot of risk, and that's the beauty of funds. There's that. You can put it potentially, if you had, let's say, for example, $1 million to invest in commercial property, rather than putting it all into one commercial property, you could potentially invest in 4, 5, 8, 10 funds at 100, 200,000 a pop, and those funds might have multiple assets in those, multiple types of commercial property in those funds. So you're spreading your risk of particularly an occupancy across a much wider range of properties, and certainly, I think that, to me, makes a lot more sense, particularly in an area if people aren't very familiar with it and don't understand it, that I think most people think they understand residential. To what extent is obviously can be varied, but commercial is a whole different beast on its own. And if you don't know what you're doing, you certainly would be taking a lot of risk, I think, to buy a direct asset on your own, because I've seen people make some pretty bad mistakes in that space.
It does happen, and it's a lot easier to do it inside of commercial property, where you can invest in a fund and therefore take parts of a commercial property. A little bit harder to do it in residential property. And there's people out there now trying to do sort of fractional property investing, where you own a bit of a residential property. It gets a little bit more complicated, but it comes to a point in time when people say, okay, is it the right time to move into commercial? You said, Damien, you did that about a decade ago, and it's going to mean different things for different people. I want to just interrogate that a little bit. We'll just go to a quick break. Stay with us, everyone. Back in a moment.
This year might just be the right year to invest in property. But before you jump in, do you have a low-rate investment loan pre-approved? It might be the right time to invest, but the wrong loan could dent your prospects for achieving the maximum return. Are you armed with the best finance at the sharpest rate? Find out with Finny. Call us now on 1300 002 023 and find out what you could save. Or visit our website, finny.com.au, to book an appointment.
Welcome back. It's Phil Tarrant, host of the Smart Property Investment Show with Damien Collins. He's the chairman of Westbridge Funds Management, which I know a little bit about your business, Damien. I've had a pick through your prospectus and the type of funds that you have, and I want to sort of break down a little bit, because it might be a more appropriate strategy for people if they are ready to invest in commercial rather than going direct or SMSF. It might augment a different strategy, and this is obviously conversations you need to have with your financial planner or your accountant when you're assessing these type of opportunities. But when do you know, or what is the inflection point, or what is the catalyst for most people to give up on resi property and move into commercial? And you often find that when people get their first taste in commercial, they never go back to residential.
Yeah, I think they like the fact that any repairs and maintenance are nearly always at the tenant's expense, not the owner's. You don't get those calls at 7 o'clock on a Friday, my hot water system's not working. I think it's one of the reasons people like it, Phil. Look, it ultimately will come down on individual circumstances. So, and their long-term planning. It's certainly, I don't think it's going to be, your first investment's nearly always going to be residential. And it's most likely your second and third, because you're still, while you're in that income earning phase, even if you are taking a loss after all the expenses, if you've got your structure set up right, then at least the tax, you'll get some tax benefits. You won't get all, so you're still losing money. So you need those properties to grow. But that's the time you want to be continuing on with residential. So depending on the person, it might be 2 investment properties up to maybe 4 or 5, depending on their capacity for growth. But when you get to that stage and you've got a bit of equity, you've got to have that eye towards, well, what's the end game here? Is it to tack on and buy 8 or 9 properties that are causing a huge cash burn and hopefully will grow, but no guarantees? Or is it to think, well, I've now got some equity in these properties, I need to start looking at income accumulation. So it might well be that you just say, well, I'm going to buy 4 or 5 residential over the journey. My goal will be to, at the end of that, my journey in residential, to sell down perhaps 2 and have the first 3 perhaps debt free. And that's what I live on as part of my retirement plan, but also then starting to move money into commercial. And it could be well through self-managed super funds. So a lot of clients who invest in our funds do invest through self-managed super funds, and we're not financial planners, so they make their own decisions about how they whether or not to invest in funds and the structure of their funds. But I certainly noticed from the applications, a lot of people are using their super funds, but obviously self-managed predominantly, and that's because they're getting to that later phase of their life, and all of a sudden they might be in their 40s, 50s, and they've not only do they have their home investment, they've got a few residential investment properties as well, but they're starting to accumulate quite a bit in super because of all that compulsory super they've put in over the journey. So there's no magic answer. It generally would be in that decade before you're thinking about retirement. So if you're thinking you're going to go to 65, for example, it might be that sort of 50 plus. That's the time to start, particularly with your using your super as part of that overall strategy, that you might go, well, I'm going to start accumulating commercial property. It's certainly not 2 years before because you're starting to run out of time, but it's certainly that 10 to 15 years prior before you, when your retirement journey is looking like. And we all like to retire at 45, I'm sure. But I think that's, if you're on a salary and a mid-income salary, it's going to be hard to achieve unless you get lucky or you're brilliant and you buy the perfect properties in every cycle at the right stage. Most of us are going to continue on to their to our either late 50s or 60s, and some might go more than that. But it's realistically 10 to 15 years prior, when you've got that healthy balance of residential. You don't want to keep plowing money into that. So they should hopefully get to a point where they're costing you less because the rents are growing, your mortgages aren't, and they start to get to neutral, positive. And then the surplus cash that you have from that, potentially maybe with your super fund, as I said, might be the way you start utilising the opportunity to get into commercial property.
And you talk about positives of commercial, but also negatives. And I chat a lot about commercial property on the Smart Property Investment Show, Damien. The economics of leveraged commercial property direct has changed quite a lot since interest rates have gone up. So rather than putting a lot of money in your back pocket, most commercial properties are still putting a bit of money in your back pocket after all the expenses, but the returns have waned quite a lot, and that's a product of market cycles. What's your sort of thoughts towards all of that?
Well, commercial property is definitely harder to leverage like you can residential. So in our funds, for example, we tend to borrow 50 to 55%. That's, I think, a healthy level of debt where it's, I think if you start to get to 70s and 80s, it's very, very difficult to do that anyway. In fact, the banks they're more nervous about commercial property because it has been more volatile historically. So look, your borrowing costs now around the low 5s in our funds now. If we took on new debt, we'd be borrowing at probably 5 to 5.3, 5.4, depending on the asset, the margins, and the BBSY, where that sits in the market at any one time. It wasn't that long ago. Yeah, we could borrow at about 1.5, 1.6%. Which was nice. You could buy an asset for 5.5% and borrow half of it and pay 1.5, 1.6%. And it was very strongly positively
good arbitrage, yeah.
Yeah. But we all knew that was never ever going to stay that way forever. We knew that the end of that cycle was always going to come at some stage. Look, the bond market is forecasting that rates actually will be lower in a year. They're forecasting that the RBA will be about 3%, not 3.6 as they are now. And so that means with the bank margins, obviously we've got hundreds of millions of debt across many lenders in our funds that we obviously get access to pretty good margins and rates. But, the long run debt cost is probably going to be, I think, in a balanced market, probably around that 4.5 to 4.8% sort of range. Now, you can still buy assets now. The yields went low because your debt cost was low. We're seeing in the market now yields, good quality assets, well leased for a long period of time at 6%, maybe even a bit more, 6.2. So there is still some benefit if you've got a risk appetite to gearing. But again, you've got to be thinking about it in a context of, Phil, when you're 25 and 30 and you make some investment mistakes, you've got some time to recover. when you get to 55 and your window for recovery is less, particularly if you've got some retirement goals. You don't want to be having to work another 5 or 10 years because you made some investment blunders. So, so I think that's important to think about, is also the level of debt you want to be carrying, because it's with the funds, they do it themselves. You don't have to necessarily carry debt, obviously, to get into the fund. That's potentially doubling debt, so it's a bit riskier. The fund might carry the debt. You might just invest straight capital into that. But certainly, as you get closer to that end goal, I'd certainly be looking to reduce my leverage levels, not be increasing them. But certainly, it's still positively geared on commercial generally. But you've got to factor in that risk component as well. It's not a free lunch. Yes, you're positively gearing it, but if the asset goes up in value, great. But if it goes backwards in value, that leverage is magnifying the downside as well.
Yeah, and sort of the point around investing in commercial property via a fund, essentially, so you're investing with other people, changes the assets that you can actually secure versus direct commercial property. I don't know a lot of younger people in their 20s buying direct commercial property because you need a much bigger deposit and borrowing is different, but managing or buying through a fund means you could probably get started a lot earlier on. But if you're buying direct commercial property, you're probably, unless you've got a lot of money, you're probably constrained in the type of stuff you can buy, whereas a fund can get you exposure to very, very different assets. What's the sort of scope of assets you have sitting inside the funds within Westbridge? Do they range from big industrial to office-based stuff, Damien?
Yeah, our asset, generally we're buying in that as a target range, generally 10 mil to 40 mil asset range. That's the sweet spot, we think, where when you get down to the 1 to 2, 3, 4 mil, to be honest, most of those aren't very good assets. They're generally got poor, not the strongest tenants, and that's really critical in a commercial property, whether that be office or industrial. What's the quality of the tenant? Because you want to make sure that A, they're going to be in business, and B, hopefully stick around a long time. And then you start to get into strata properties as well, and you don't control it. You can't, strata office. I see people go into that and not very good returns. So the 10 to 40 mil spaces for us is good because it's generally most private individuals are not in that space. You occasionally get some very high net worth private individuals, privates in that space, but mostly your average investors not in that space. And then up to about 40 mil, generally most of the big institutions are not in that space as well. So they're looking to buy the 100 mil assets and, in the main streets of Sydney, Melbourne and Perth and Brisbane, either an office or really big industrial sheds. So, but you can still get some great property. So we like that space. I mean, Coates Hire is one we just bought recently. They've signed on for a long-term a 7-year deal with us on a property we bought. It was month to month, but we did a deal with them. So we got some fantastic Bunnings subsidiary tenants. We got some fantastic multinational tenants who are in that sweet spot of that 10 to 40 mil. And that for us is a good spot. As I say, we keep away from the individual investors mostly, and then also a bit under the radar of the big institutional and super fund investors. We think that's the sweet spot where we can get some really good quality assets with less competition.
Yeah, so you've certainly carved out a competitive advantage, I guess you would call it, inside of that realm. And $40 million in Sydney will get you something very different. $40 million in Townsville, for example. I don't know why I plucked that out, but different markets like residential property, different markets have different asset levels, different asset caps, which will shape and persuade and frame how you invest in property. Investing in commercial property, if you can go direct, if you can do that with cash, a cash buy between 10 and 40, there's a few families around that can pay that sort of stuff, but they don't normally exist in most people's world. But investing via a fund can work well. I just want to sort of get into that a little bit, Damien. Let's go to another break. Stay with us. Back in a moment. Welcome back. It's Philip from Smart Property Investment. I still call myself Philip. It sounds like I've done something wrong. Chatting with Damien Collins from Westbridge Funds Management. Now, Damien, I get the appeal of investing in commercial. I like the strategy, and I think most investors tuning into this, if they've got sort of more than 3 or 4 properties, are probably thinking about commercial investment at a point in time, whether it's inside or outside of their super. To your point, most sort of individual investors are probably competing for very similar assets below that sort of $4 million mark, just, put using $4 million alone. If you're on a 70% lend, you've got to stump up a fair bit of cash, and that you've got to find from somewhere, whether you refinance debt on your resi properties and withdraw the money out. It means you're paying for it, increased mortgage rates on your resi stuff. So how you come across that money? Typically, I see, Damien, a lot of people start getting into commercial property business owners when they get a bit of a check. They might sell something. It's normally when they start parking it. But investing in commercial property funds, what's the sort of ceiling to get into that? Because, to the point, if you're doing 70% on $1 million, you've got to find yourself 300 grand plus all the associated costs. You can get into commercial property funds with a lot less money, can't you?
Yeah, you certainly can. Look, every fund is different, but we run them generally depending on the fund. So some funds are what you call retail, which means anybody, open to anyone, and some are only open to sophisticated investors. Generally, it's 50 to 100,000 as a minimum, and plenty of clients invest 50,000, 100,000, and plenty invest more than that as well. We find some of our high net worth clients, some are worth $100 million. Like to chip in $500,000 bricks lumps at a time. So and they spread that around that way, and that's their direct that's their investment decision. So you certainly can get in at a lower, much lower. You could never get a commercial property, even 100,000. You're not going to get much really. You're going to get as you say, even if you borrowed 70% from the bank, still got to pay stamp duty. 100,000 is going to get you. I don't think you get you anything in Sydney. Can't see you getting much commercial property for 300,000 or 350,000. And even in the other markets around the country, you're really going to get a rubbishy little strata office in the middle of nowhere that's could well sit vacant for a long, long time. So certainly does give people those opportunities to invest in properties that they wouldn't otherwise get access to.
Yeah, and that is a point. You're spreading your risk. It's allowing you to diversify. If you get one right, you get one wrong. Typically, it balances out. So you're not going to bet the farm on it. Do you get nervous when people are sort of chucking in big? If they're not high net worth individuals, they're pumping all their money into funds. You sort of put a question mark on it.
Well, I think so. We don't give personal advice on the funds. People make their own decisions. Certainly, I would suggest to anybody looking to invest in a fund. You don't put all your eggs in one fund or one basket. If you've got, for example, if you had $500,000 to put into commercial property, I'd suggest, 3, 4, 5, maybe different funds is the way to go, just so that you're spreading that risk around. As you said, and funds can have multiple assets. So our diversified funds have multiple assets in them. So that does help spread the risk. But at the same time, if you cross 3 or 4 funds, then you're really, you can't get rid of risk, but that helps to reduce your risk by having exposure to multiple assets across multiple states and multiple tenancies. So I wouldn't give any personal advice in that space, Phil, other than to say I would strongly encourage anyone to certainly diversify their holdings in commercial and not be betting the farm in one fund or one individual property. I think diversification is key in that particular space.
Yeah, and that's not advice by any means. It's just the baseline philosophy of diversification makes sense from an investment point of view. And if you're going to go down a pathway, apologies for the disclaimer, but make sure you go and have a chat with the right people to ensure you're making informed decisions around it. And that might be a financial planner, it might be an accountant, it might be any other sort of associated property or finance professionals to ensure that you're embracing the appropriate strategy for the right outcome that you need now. But you mentioned you've got different sort of funds, Damien. So you've got stuff which is, inverted commas, a little bit more riskier, probably got higher returns and more sort of safer, conservative type of funds, depending on the client or the investor.
Yeah, I think that's really critical for everyone to understand. Is there's anything that comes with a higher return is carrying higher risk. That's just the reality. There's no such thing as a free lunch. The safest thing is probably a government bond, Australian government bond, but you're getting 3.4, 3.6, 3.8%, whatever the rate is on a maybe 12-month bond. So you're not going to get rich on that, but at the same time, you almost certainly should get your money back from the Australian government. I don't think they're going out of business just at this stage, certainly. So, but when you go into I look at it in there's 3 levels of risk, I guess, that we have across our fund range, and there are different types of returns. So we've got a diversified series of property funds, and And what they do is we buy nationally, we buy across the country. We build a fund. Current one, we've got number 4, diversified fund number 4, aiming for $100 to $150 million of assets across the country and across the different asset classes as well, industrial, retail, not really looking at office too much. We're sniffing around, but nothing has appealed to us yet in that space, and across multiple states, WA, Victoria, Queensland. And so that one will be generally well leased to great tenants and who are then going to pay the rent and locked into long-term leases so they can't just exit. And we know that, as best we can, we feel comfortable that they're going to be around in business for a long time. Those funds at the moment, with the debt levels higher, are paying around 6.5% return out to investors, and that's paid monthly. So you get a monthly distribution, and obviously us as the fund managers, all the work in the background, manages it, making sure the rent's collected, making sure the tenant's doing all the things they should be doing. So that one is 6.5% yield. Obviously, you're targeting capital growth. There's obviously no guarantees, but reality, look, industrial property's done really, really well in the last 3 or 4 years. No guarantees will continue to do that. You would certainly hope to get some capital growth out of that asset, but it's unlikely you're going to get, compounding 10 or 20%. That's just not likely, not realistic. You might get potentially 3 or 4%, but again, no guarantees. It's you might get no capital growth on that sort of fund, but generally over time, in the long run, a commercial property should grow in value in the long run, similarly to what the rents grow. So if the rents are growing 3 or 4% in the long run, if that tenant's still there, the value of that property should grow roughly that amount per annum. But of course, there's a lot of other factors into it. So that's why it's not guaranteed. So that's what you would call still carries risk. There's no doubt about it. But it is a lower risk proposition than some of the other asset classes. So then we have what we call value add funds. So, and we do limit those only to sophisticated or wholesale investors because they do carry more risk. So that means that they're value add. So basically, we had an industrial total return fund. We bought a number of assets. One of them was the one I mentioned there, Coates High. It was on a month-to-month lease. So it means we were able to get it at a discounted rate because it was hard to get debt funding on. We went into Coates. We agreed to spend $400,000 on some works to the premises, and we got an immediate value uplift of 25% on the asset. And they signed on for 4 years. 7-year lease, and then we got a 25+% uplift in the value of the asset, within 6 months. Another one was we bought a cold store facility, and we knew the tenant was looking to expand. We went and put basically a conditional contract on the property next door. We cut a deal with that tenant to, instead of staying on for only 2 or 3 more years, we cut a deal just for them to stay on for another 10 years. And then potentially we're going to build on that adjoining site. Once we had that deal stitched up, we obviously went unconditional on that contract, and we got a 40% uplift within 6 months. So they do carry more risk. Both those tenants could have said, no, I'm not staying, and left the premises, and I'd be sitting with an empty premises. So in those particular funds, we're generally targeting you focus on the total return, not just the yield. So there might be some yield on the way through, but you're targeting that sort of 10 to 12% total return. So it's a capital value add play as well as a yield focus. And then there's the high risk end of the spectrum, which is residential development funds, which we also do. That's targeting generally 15 to 20% return annualized, but they're lumpy. You put your money in and you hope to get your money back out, and the goal is to get your money back out within sort of 2 to 3 years, depending on the time of the fund. And certainly I've done a lot of residential development over the journey, and when it goes really well, it can go really, really well, but it can also, be challenging. You've got builder management issues. At the moment, builders going broke. We saw a big one go broke in Victoria recently, 1,700 homes under construction. That can happen. The sales values can decline. So building costs go through the roof like we've seen the last 2 or 3 years, albeit stabilising now. Builders can go broke. The sales value at the end, you sell some off the plan, you sell some at the end. So that's really high risk. You've got to be prepared in that, particularly in that space, that you can, and it's possible you could lose all your money. So you would never, ever, I might say to people, anyone thinking of investing in a residential fund, don't put in any more that's going to make you lose sleep. So if that's going to be $1, don't go into it. If it's going to be $100,000 and you're comfortable with that risk, well, then that's okay. But you should never. And again, we don't give personal advice in this space, but as a general philosophy, these things can be a good way to get into property development without having to put all your eggs in one basket, do it yourself. But they do carry risk, so never put in more that's going to make you lose sleep at night, because they do carry risk and things can go wrong. So they're different return spectrums. You've got one at the lower end where you're looking at maybe 6.5% to maybe 9% return per annum. That's the target. None of them are guaranteed. Then you're looking at the next range is sort of 10 to 12, 13% with a bit more value add, a bit more risk, but not developing from scratch. And then you've got the develop from scratch, which is the much higher risk end of the market and potentially higher returns. And we've all seen, we all know Harry Triggerboff in Sydney, who's been in his 90 plus, and he's made billions out of residential development.
He's made a few bucks on the way through, hasn't he?
But for every Harry, there's a fair few have gone by the wayside. So you just got to be very careful in that space and spread your and just be prepared to. And I wouldn't be putting certainly big chunks of my net worth personally, and I recommend anybody now you wouldn't put your big chunks of net worth into those high risk things, because they certainly can go really well or not so well as also.
Risk and reward. And I'll just conclude with this question, Damien, and it's around commercial property. Are you had some examples there of how you sort of manufactured an uplift in valuations. Are you seeing pressure the other way? I know a lot of people sort of operating in and around sort of commercial funds, whether or not the inherent assets are stacking up on rents, etc. Is there something to be concerned about valuations on commercial property at the moment?
Look, in some sectors, Phil, there is. I'm reading the AFR regularly, and certainly there is. Particularly around offices, now we're all going back to work, but still a lot of people are working, some partially from home. I think people working full-time from home's less, but partially from home. So companies are looking at their office space. So office is certainly under the most pressure in terms of valuations. And simple thing is for when the interest rates rises, the risk-free rate, everything's benchmarked off that. Well, people say, well, instead of buying an asset at 4.5% or 5% net return, I might want 5.5% to 6% net return to factor in where I think things are at the moment. So that automatically means, all things being equal, that valuation would come down. So I think office is where the biggest risk is. We've been by design, and we've been very heavily in industrial property. We're 60% or thereabouts in industrial, and we saw rents go up across the country, 40% in Perth, 20+% around the country. So even if we do get some what they call cap rate changes, where the expected yields will go up because the rents have gone up so much, the markets, that's certainly holding off valuation issues in that particular space. Retail's a mixed bag depending on which centres. So look, it's something we regularly work through. We're getting a lot of our properties valued at the moment as part of our compliance regime. We haven't seen it any, certainly again, because we've been in a sector that's performed so well. But I think it's something everyone should be thinking about is what's the underlying value of the assets that you're getting into, and but all the fund managers have to. So there'll be some have to value the properties, whether by direct evaluation or formal third-party valuation. Everyone's got a different policy on it, but certainly, there's the office sector is the one most at risk, I think, of seeing valuation declines.
Yeah, well, it sounds like we probably read the same stuff, Damien. So, aware of it. But, it's good to be conscious of that if you are investing in commercial property. And if people want more info about what you guys are doing, Damien, what's the best way to track you down?
Yeah, so if you Google Westbridge Funds Management or go to www.westbridgefunds.com.au, have a look there, and you can see some examples there of the funds that we've got going at the moment, and what's happening. And you can also sign up for future opportunities. Basically, you'll get our newsletter, which we do once a quarter, and but also when funds come up, you'll get on that list as well. And just, I think anyone looking at property, commercial property, certainly don't jump in the first one you see. I think I'd be having a look at it, get some information and get a better understanding of what's involved as well. And all the pros and cons of investing via a fund. The liquidity, yes, they're not liquid. You can't just sell out tomorrow if you want to sell out. They're not particularly unlisted funds, obviously. Listed funds are different, but unlisted funds are not liquid. So there's all pros and cons. I think anybody looking to get into this space should spend a bit of time doing some research and getting a good understanding of it. Obviously, if you've got professional advisors, talk to them as well about it. But certainly, if you go to Westbridge Funds, there's lots of educational content, and you can also sign up to get on our mailing list for future opportunities as they come up.
All right, there you go. Damien Collins's chairman of Westbridge Fund Management. Thanks for your time today. Always enjoy catching up.
Thanks, Phil.
Nice one. I hope you enjoyed that, everyone. Heaps of other commercial discussions on the Property Investment Podcast Network, or you go to smartpropertyinvestment.com.au. Check it out there if you want to get more informed about commercial property. Social media, Smart Property HQ, you find us there. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you looking for a new challenge that combines your existing skills with the exciting world of mortgage broking? Well, listen up, because we've got the perfect opportunity for you. Introducing the Advisors New Broker Academy 2023, a free event designed for professionals just like you who want to learn how to become a trusted broker for their clients. Coming to Brisbane, Melbourne and Sydney in June, you'll learn from industry specialists and gain crucial industry insights and intelligence to become a go-to broker. You'll also have the opportunity to network with brokers at all levels and gain a competitive edge in the marketplace. Register now for free at newbrokeracademy.com.au and join the top brokers of tomorrow.